Now, currently, the value of US gold reserves is about 2% of Treasury outstanding, compared to roughly 17% in the 1970s and actually close to 40% in the 1940s. Now, at 17%, it places gold around $25,000. At 40%, $50,000 an ounce. Now, I'm not saying liquidity providers don't expect this global gold demand to taper off anytime soon. And this places the Fed stick handling the 8,133 tons of US Treasury gold in a position where it would be far better to revalue gold sooner than later. Now, following the ECB announcing in June that gold overtook the euro as a global reserve asset, Mohammed El-Erian, very well-respected guy, he's discerned for the first time since 1996, foreign central banks now hold more gold.
A surprise revaluation by the US, China, or both could spark a new era where gold, once again, anchors the value of money. It would upend assumptions about the dollar, the yuan, and the very meaning of financial security. Today, the 260 million ounces of gold supposedly held by the US Treasury are recorded at only $11 billion. At current prices, their value would approach $936 billion, still modest compared to the $37 trillion federal debt. Some analysts suggest a possible revaluation to at least $20,000 per ounce. Skepticism about a U.S. gold revaluation is a mistake. AndrewMaguire underscores that the Bank for International Settlements Tier 1 reclassification was the first signal, prompting central banks to swap depreciating fiat for gold at any price. He notes that gold has gained $2,000 since, and a U.S. revaluation is the next logical step. A turning point has arrived in the global monetary system. AndrewMaguire says that by adopting Basel III-compliant yuan gold pricing, China is stealthily assuming gold convertibility, displacing the dollar's dominance. Escalating trade tensions with the U.S. have prompted China to take a defensive stance economically. This has become a major gold price driver in 2025, and that trend is expected to continue in the years ahead. The prospect of a gold revaluation, or a disclosure of substantially larger Chinese gold reserves than officially reported. A full audit of U.S. Treasury gold is being called for, and it could expose a major secret. According to AndrewMaguire, if the White House delays, a bid-only market will be forced, which would prove that the Fed has lost control. Before we dive into AndrewMaguire's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon, so you never miss a moment when truth meets the market. Let's get into it.
There's been some very understandable skepticism around US gold market revaluation. Because we had the same kind of skepticism when people were doubting that the Bank of International Settlements would revalue gold as a first-tier high-quality liquid asset. So I'm going to update and run through the gold revaluation footprints we're now evidencing, along with the most likely dollar gold price expectations. Now, I'll also provide some end-of-year realistic silver targets. Now, bearing in mind, the bulk of our information gets distilled through the largest liquidity providers, physical liquidity providers, who see both gold and silver grossly undervalued versus gold and silver that broke out months ago into all-time highs. So let's start with gold. Just as the Bank of International Settlements inflection point, where they revalued gold as a first-tier high-quality liquid asset, drove a race by global central banks to swap fiat currency assets for physical gold, just 33 months later, gold price in dollars is currently $2,000 per ounce higher. So net out the intra-month legacy market volatility, and gold has averaged out a very quiet, stealthy, relentless $60 per ounce rise in price. This relentless gold demand has driven the legacy paper market to an impossible to maintain divergent inflection point that can only be resolved by a massive bid-only margin call or a US Treasury gold price revaluation. So now that global physical exchanges have become sufficiently liquid to benchmark a real supply demand gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. And we'll kind of look at those footprints. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has been driven into all-time highs. But as we've been focusing on, the real game changer is that China took the gloves off the moment the Yuan gold price became fully Basel III compliant. Now, the fact that this is still unnoticed by the mainstream media, these are the analysts who try and form fit news releases, interest rate drivers, these kind of things which influence the paper market actors greatly, but they completely miss the underlying race by central banks to swap dollars and associated fiat currencies, this whole range of fiat currencies, for physical gold. But here's the key: at any price. They don't care if it's higher or lower, they are accumulating. And with the Basel III compliant Yuan backed gold price being benchmarked through a growing network of physically backed SGE exchanges, Western facing, Beijing is stealthily assuming the gold convertibility mantle. The ease of hedging the Yuan price against all other FX currencies, bonds, etc. And so the PBOC is rapidly usurping the dollar as the global hegemon, ultimately forcing Basel III compliance on the last holdout, non-Basel III global central bank, forcing an imminent gold price revaluation. Now, little noticed by the mainstream media is that enabling the PBOC to directly benchmark physical gold against US Treasuries, it unlocks vaulted bullion to be used as financing collateral within the entire BRICS system and facing the West. Now, gold is pouring into these Western-facing gold vaults, and simply, so how it works is this gold simply swaps hands completely outside the legacy system in the vaults underpinned by Basel III compliant Yuan gold. The gold doesn't leave the vaults. Hence, there is no dilution when it moves around, no volatility when it moves around. And as we summed up in our last episode, with the SGE gold price also seamlessly interchangeable with Western central banks' underpriced legacy COMEX exchange gold, that gold has been drained, incentivizing every single global central bank to race to swap more fast depreciation dollars to buy the same ounces of gold. Now, the White House understands US Treasury gold is once more under attack by foreign central banks, much like it became under attack when Nixon in 1971, when Nixon took the convertibility of gold versus the dollar. So really, the only tool that's left in the Fed's gold price suppression bag of tricks has been completely usurped. If those prices do not begin to reflect a real physical supply-demand price, every single ounce is going to get drained. It's no coincidence that Treasury Secretary Bessent is currently demanding a full Fed audit, which includes the 8,133 tons of Treasury gold being stick-handled by the Fed. Now, we talked about it a long time ago. It's gone off. It seems to have disappeared under the radar, what was going on. It's on the front burner. Even Bloomberg was talking about that this morning. So it is on the front burner. This would be the first full audit, trusted audit, that would fully inspect all of the vaults, but it was also uncover the extent of double ownership claims on US Treasury gold. Bearing in mind, a lot of it was lent out. Now, this has to be concluded before the US gold GRA account, the gold revaluation account, can be marked from $42 or 8 billion, which is at current prices, now verging on at real market value at $1 trillion. So 8 billion to $1 trillion in a click of a mouse. Now, obviously, this revaluation process itself would drive gold significantly higher than current prices. And that would provide a healthy buffer when it's revalued. Now, if the White House does not move to revalue soon, there won't be enough bullion to meet delivery obligations, which risks triggering a force majeure condition, in turn driving global prices into a bid-only condition, forcing the Fed to become a price taker at much, much higher prices. Now, they can print their way out of it, but it's going to drive the price higher.
Germany's failed gold repatriation attempt in 2017 exposed a global fraud. AndrewMaguire claims that the bars returned from the New York Fed were not the originals, indicating that the system was critically short of physical gold. Now, with the LBMA and COMEX paper market broken, the Fed is short physical gold while central banks are long. The footprints are clear, with major bullion banks covering their derivative bets, a sign of an imminent U.S. gold revaluation. The potential revaluation of U.S. Treasury gold represents more than an accounting adjustment. It signals a fundamental reassessment of gold's role in the modern monetary system. As global financial pressures mount and traditional monetary tools reach their limits, policymakers are increasingly considering unconventional approaches to address fiscal challenges. While no official confirmation exists, these signals suggest the concept is receiving serious consideration, as indicated in the Federal Reserve's own research notes on international reserve revaluations. Let's get back to the interview.
In February 2023, the Fed refused to allow the German Bundesbank to inspect their holdings of the New York Fed vaults. Now, this led to the Bundesbank request to immediately repatriate the first 300 tons of their 1,350 tons deposited after World War II. I mean, a lot of it was in the 50s and 60s, but after World War II. And these were numbered bars. However, instead of, when requested, instead of saying, oh, okay, we'll fly these 300 tons out, it's a technically deliverable T+0, really, it's in the vault. It should be in the vault. You should be able to just hand it over or get it securely moved from a Brinks or Loomis truck into the airport. So really what you should be is 12 days, which is normal. We see this kind of silver being shipped around in 25-ton lots. So really 12 flights, 25 tons, should have done it. Yet they was talking about a 7-year T plus 2,555 day delivery process. This is ludicrous. It's beyond credible, but the records are there. That's exactly what they actually wanted to do. Now, this spilled the beans on just how short of gold the CME LBMA cartel were. They were caught out. This first central bank delivery default, this was a delivery default. It raised a major red flag that the entirety of the published or unaudited US Treasury gold holdings were likely double counted or rehypothecated to some degree. And while an embarrassed Fed scrambled to cut the timeline to repatriate German gold when it did arrive in Germany, these bars were discovered not to be the same bars as originally deposited. In fact, the mix of bars included newly minted bars mixed with some 1930s 22-carat melt gold, further proving the original Bundesbank bars had been sold and were being repaid in the form of a shell game shuffle. So let's have a look at the charts. Now, while this fast was playing out, and I'm going to focus right on this circle right here, it was no coincidence that during exactly the same time, the LBMA, ABN AMRO Bank, they sent out a letter on the 1st of April that was sent to one of our clients stating they would have to be cash settled on their bullion redemption requests. With their permission, we published this letter. With the client's permission, we published this letter. And this drew a horde of fresh physical delivery requests, uncovering major cracks in the LBMA's ability to deliver on their 100-to-1 leveraged unallocated gold holdings. In fact, it was a Reserve Bank of India report in 2010 that actually talked about 98-to-1. Now, over that Easter weekend, right where the arrow is here, a hastily called presidential meeting was held with all the major bullion banks. This was followed on Monday, the 8th of April, with the commencement of a major officially driven $600 gold intervention. And there's no other word for it. A gold market intervention from driving the price from $1,600 to around $1,000. Now, it concluded, guess when? On the 31st of December, 2015. Now, following Nixon decoupling gold from the dollar to halt foreign central banks redeeming physical gold against debasing dollars, these sort of derivative gold market interventions were made possible by launching the paper-settled COMEX Gold Exchange. We talked about it more last time. And really, the COMEX was geared up to do what it said on the box, namely what the 10th of December 1974 WikiLeaks memo had revealed, the ability to create as much paper gold as may be necessary to dilute and manage the gold price. And we saw lots of them. But these paper-driven COMEX LBMA interventions continued until the BIS short-covered all the remaining 500 tons of their derivative gold bets 1 month before revaluing gold as a first-tier, high-quality liquid asset on the 1st of January 2023. It's in your face. The reason I bring this up now is we're once again at the critical inflection point where the entire Western-backed, cash-settled CME LBMA unallocated gold market has broken. But the COMEX price-setting mechanism is what's really broken. Because they're being forced to become price takers. This time, every single central bank, sovereign and bullion bank are long physical gold, leaving the Fed as the only central bank short of gold. Now, looking at the scope of these underwater positions, we can see the Fed is being forced to short cover. We can see that step by step by step. Feedback from our physical-facing liquidity providers provides invaluable evidence the Fed is, as best as possible, short covering into rising physically driven prices. This is also evident in the largely unwatched OCC, Office of the Comptroller report, which we went through over the last 2 or 3 episodes, which actually list the unallocated precious metals, foreign exchange, over-the-counter gold and silver positions that directly relate to and are no longer able to be physically hedge the rehypothecated US holdings because they're being demanded for delivery. And now we've previously looked in detail at how these 20% haircut LBMA unallocated bars have been coming into the global crosshairs for delivery. And it's why we have observed agent banks, JP Morgan and Citi closing all their decades of Fed-held 5-year and longer derivative bets.
A rise in the price of gold would essentially reflect a concerted monetary devaluation of all fiat currencies, carried out simultaneously. In the event of a gold revaluation, Chinese citizens could emerge among the biggest winners. The Shanghai Gold Exchange itself has become a central player in the global gold market. It's predicted that the price of gold will soar in the next 5 years if inflation takes hold, and the economy underperforms expectations. This would be a much more risk-off outlook, an environment in which investors sell their riskier assets to seek protection in safe haven assets. If a US or Chinese gold revaluation does trigger a new monetary era, do you think it will accelerate the collapse of the current dollar-based system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.